Identifying and trading Forex chart patterns with confidence. Introduction. Forex chart patterns are visual representations of price movements on price charts. They provide valuable insights into potential market trends and reversals, making them essential tools for traders to identify trading opportunities. By mastering the identification and trading of chart patterns, traders can gain confidence in their decision-making and improve their overall trading success. In this text, we will explore key chart patterns commonly found in Forex trading and discuss strategies to trade them with confidence. Common Forex chart patterns. Head and shoulders. This pattern consists of three peaks, with the middle peak, head, being higher than the other two, shoulders. It signals a potential trend reversal from bullish to bearish or vice versa. Double top and double bottom. These patterns consist of two peaks, double top, or two troughs, double bottom, of similar height, indicating a potential reversal in the prevailing trend. Triangles. Triangles are formed by converging trend lines, indicating a period of consolidation before the price breaks out in a new direction. Common types include ascending triangles, descending triangles, and symmetrical triangles. Flags and pennants. Flags and pennants are short-term continuation patterns that form after a significant price movement. They are characterized by parallel trend lines and signal a potential continuation of the prevailing trend. Wedges. Wedges are similar to triangles but have a steeper incline for both the upper and lower trend lines. They can be either rising wedges, bearish, or falling wedges, bullish, and signal potential trend reversals. Identifying chart patterns. To identify chart patterns, traders must observe price charts and look for specific formations that fit the characteristics of each pattern. Traders can use various charting tools, such as trend lines, to draw and confirm the pattern's validity. Additionally, traders can use technical indicators like the Relative Strength Index, RSI, or moving averages to validate potential breakouts. Confirming chart patterns. It is essential to confirm chart patterns before entering trades. Confirmation can be achieved through additional technical analysis, such as volume analysis, candlestick patterns, or oscillators. For example, an increase in trading volume during a breakout confirms the validity of the pattern. Trade entry and exit strategies. Once a chart pattern is confirmed, traders can plan their entry and exit strategies. For breakouts, traders may enter the trade when the price breaks above the pattern's resistance, in the case of bullish patterns, or below the pattern's support, in the case of bearish patterns. Stop-loss orders can be placed below the pattern's breakout level to limit potential losses. Profit targets can be set based on the pattern's projected price movement or key support and resistance levels. Managing risk and position sizing. Effective risk management is crucial when trading chart patterns. Traders should allocate an appropriate percentage of their trading capital to each trade and set stop-loss orders to protect against adverse price movements. The position size should be adjusted based on the distance between the entry point and stop-loss level to maintain a consistent risk-to-reward ratio. Multiple time frame analysis. To enhance the confidence in trading chart patterns, traders can employ multiple time frame analysis. Examining the same pattern on different time frames provides a broader perspective and increases the reliability of the pattern's signals. Avoiding overtrading. Intermediate traders should avoid overtrading and focus on high-quality chart patterns that meet their trading criteria. Trading every pattern that appears on the chart can lead to excessive transaction costs and increased risk exposure. Conclusion. Identifying and trading Forex chart patterns with confidence is a valuable skill for intermediate traders. By mastering the identification of common chart patterns, confirming their validity, planning effective entry and exit strategies, managing risk, and avoiding overtrading, traders can gain confidence in their chart pattern analysis and make more informed trading decisions. Chart patterns, when combined with other technical and fundamental analysis, provide a powerful toolset to improve trading accuracy and overall profitability in the dynamic Forex market. As with any trading strategy, continuous practice, refinement, and experience are essential to achieve consistent success in trading chart patterns.